Hello, everybody, and welcome back to the Skift Travel Podcast. I'm Skift's editor-in-chief, Sarah Kopit, joined, as always, by Skift's head of research, Seth Borko. Hey, Seth.
Hey, Sarah. Really excited about our guest today.
Yeah, so Lex Harris, managing editor extraordinaire here at Skift, and, frankly, a markets expert, is here to talk to us today about what on earth is happening with the market, the economy. Everything was going so well, and now it's, I don't know, not?
Maybe not.
Maybe not. So we're going to get into all of that in just a second. But first, we have a little bit of housekeeping. Quick reminder, send any questions you may have for Seth and I to podcasts@skift.com. That is podcasts with an S at the end. And if we like your question, or maybe even if we don't, we might read it on the air. Also, please don't forget to follow, subscribe, hit that like button for this podcast wherever you're listening or watching. And if you're enjoying the show, please rate us 5 stars or leave us a positive review so we can spread the word about the Skift Travel Podcast. So, got rid of that up top. Seth, you follow the markets a lot. You were the brainchild behind the Skift Travel 200. What's going on? And Lex, you too. What on earth is happening?
Yeah, I mean, they're down. I think we've seen yesterday was a massive sell-off. I'll let Lex chat about that a little bit. Big sell-off. Actually, travel stocks did pretty good yesterday, all things considered. So, one of the things that I think about is that travel never gets, I think, its fair share of being its own sector, right? People talk about consumer sectors, they talk about tech, they talk about healthcare, they never talk about travel. We built a stock index that treats travel as its own sector. And yesterday it was down 1 or 2% when the market was down 3 or more percent. So pretty good. Except if you zoom out and look over the last week, travel is down 8%. It's one of the single worst performing sectors over the past week. And so that really makes me think it's not about this specific one day of action. It's about growing concerns that are mounting over this earnings season about will the U.S. and global economy slow?
Yeah.
Sorry, go ahead.
Oh, no, I was just going to say, so we got the jobs report. I think that was the thing, I think, that kind of took this mainstream, earnings. I think people in the business look at earnings, they follow them. But when you break into my mom calling me and say, Sarah, what's going on? That type of thing, that came from the jobs report, right? So we've got the jobs report, we've got, what else? Earnings, and there's one more.
Mixed earnings. And people are worried about the Fed, and people are worried about China.
Interest rates.
There's a million things people are worried about.
Yeah, there's an esoteric term called the carry trade, which we won't get into, but that was up there in the list of terms as well.
I know. I had to do a lot of reading on the carry trade in recent days.
Oh, come on. Our listeners need to know. Give us the Crib Notes version of that.
Okay. The rough version is that people, traders, big investors, hedge funds would borrow money in Japanese yen, which had zero interest rates. And then they would take it and convert it to dollars and then buy tech stocks. And you might ask, what could go wrong? And if you're buying a lot of overpriced tech stocks. And basically the Bank of Japan raised interest rates, and then a bunch of traders got caught on the wrong side, and those trades had to unwind, which magnified some of the losses you might have seen in the past couple of days.
And I think part of it is that it came at a particularly bad time, though. It was that forced sell-in from this yen movement, which is, by the way, from a travel angle, totally going to ruin my planned trip to Japan. I was going to go in September. I was thinking about how cheap things are going to be, and not the case anymore, right? The yen is up pretty big, so my trip to Japan just got significantly more expensive. But I think it also hit at a time when, to our earlier point, people were worried about earnings. People were worried about the unemployment report. People were worried about the presidential election, stuff like that. It matters for the market. So people look for catalysts. And every once in a while, you get the yen carry trade is your catalyst, but I think you need a catalyst that hits on a broader background of concern to really see
That's right.
what we're seeing.
When it all collides at the same time is where you start, and you started to really feel it in recent weeks. Just people feel it. There's an anxiousness, there's a nervousness, and and part of it is just things have felt too good for too long, meaning we've gone, this was in your store, other than, it's always weird to write ex-COVID because COVID was so bad. But because it's so abnormal, a lot of people just kind of move past and say, all right, well, when was the last comparable? And so you have to go 15 years before you had a recession, which is a really long time.
Yeah. And so for the travel space, it's been kind of like the roaring 20s since the pandemic ended. I mean, it's just been on a tear, like astronomical growth. So I'm curious what you both think. If we are in a softening or a pullback, what do you think happens first? Like specifically for travel, like where will we see it? Will it be airlines? Will it be hotels? Will it be business class suffering, nobody's buying those tickets? Like, where do you think the first real sign of a pullback logistically, practically happens?
What I would say is it depends how, what this recession, if there is a recession, looks like. So in other words, if it's coming, jobs is so central. If you read Seth's story that published recently on the Skift Travel 200, it refers to the sensitivity of the travel sector to consumer spending and how exposed it is. And jobs have been so strong for so long and have been such a support. And that's why in my time in Skift, every earnings story is about record numbers, et cetera. So that's where you're going to start to see those slight chip aways at like revenue at hotels, and they're all the obscure metrics they talk about that you're going to see those. It's at a 5%, it's going to be 4%, and you're just going to start to see them start to ratchet down that guidance for what earnings are going to look like.
And can I throw another
Please.
wrinkle into this, which is that what we're talking about, what Lex is talking about, is the demand side of things, which is, do consumers want to spend on travel? There's another side of it, which is obviously the supply side of things. We have not seen, Sarah and I, we had a podcast on short-term rentals talking about short-term rentals are thriving where hotel supply has been constrained. We haven't seen a lot of new hotel supply. Interest rates are high. It's hard to build hotels. So it's where supply and demand meet in really negative ways where we've seen the most damage. And I would highlight the airline sector, which has seen oversupply. And so part of the reason why we've seen such a weak airline earnings this quarter is you've had weakening demand. At the same time, you've had in some markets, particularly leisure markets, a huge amount of oversupply and overcapacity. And so I think it's where's it going to, your question, Sarah, is where's it going to hit first? I think we're starting to see it hit first in airlines because airlines have more dynamic supply. They put a lot of supply in these leisure markets. Now they're oversupplied, and they're oversupplied as they see signs of demand weakness. And that's a far worse place to be in than, say, the hotel industry, which is seeing some demand weakness, but hasn't maybe grown supply as fast. So just to bring in that extra element there that I saw kind of looking at some of these.
Yeah.
Brands.
That's right. Can I say so importantly, I do want to say before we get too far that job market is still pretty strong. So the thing that scared everyone on Friday is it went to 4.3% unemployment rate, which is it's a very low unemployment rate. And usually the reason everyone is scared is usually it goes up and it's not like it just stops, right? The momentum builds and the dynamic takes you, and then you see before you know it, you're at 5%. But there's a lot of reason to think that's not what's going on here, right? So at least some of this could be just a lot more people coming into the labor force. So instead of like a ton of layoffs that are leading to a rising unemployment rate, you just have more workers. You have a surge in immigrant labor. You have more people coming back to the workforce, which isn't a bad thing, all things could say. If you remember after the pandemic, we had this huge labor shortage. So this is actually like, at least I don't want to sugarcoat it. Like it's rising. You're seeing a lot of signs of weakness, but you're not seeing that. The reason people aren't saying, hey, there's a recession right now is because there's still that a lot of underlying strength.
And cut me off, Sarah, but we might be going too deep here, but I would fully agree, right? Like I was looking at travel earnings of the U.S. publicly traded companies in travel industry. And, they're on pace for 5% revenue growth. That's kind of the pace. That's not bad. And that's also why I was kind of highlighting the airline earnings. Where we're seeing problems is where weakening demand hits that excess of supply, because the actual demand environment it's not the roaring 20s, but I don't think we're in the 1930s just yet either, right? Like it's just a more normal, and this is something on the research side, we've been talking about since the beginning of the year, which is normalizing demand, which is that, hey, wait a second, guys, we grew at double digits. That's not going to keep happening. Like we're not startups. These are not tech companies. This is, some of these travel companies are hundreds of years old, huge, thousands of employees, thousands of rooms or whatever. These are not necessarily double digit, maybe low double digit numbers, but they're not 20, 30, 40% growth numbers. So we're looking at 5% revenue growth and some earnings growth as well. I mean, some sectors less, some sectors are seeing negative earnings, but for the most part, positive earnings, positive margins, single digit revenue growth. That's not a disaster. It's only becomes a disaster when you plan for double digit and you don't get that.
Mm-hmm.
It's going to be interesting for me because one of the things that I do for Skift is I do a lot of, television stuff around the holidays, talking about people that are going out and traveling. So I've been at Skift for a year now. Every single time I have done this, the records are like, it's been a record, a record, more than the last time, right? It's never been, well, this is the third highest, point of travel. It's always been this is on this date the most people that have ever traveled on this date. So Labor Day is coming up. That'll be the next time that we'll do this like flurry of, what does the travel ecosystem look like for people flying and driving, for generally this is just domestic travel. So I'm curious when they come out with that, what those numbers are going to look like. It's right around the corner. So I'll report back after that happens.
I don't want to be too much of a pessimist there, but maybe you should start planning like a good key phrase that you could use for like good, not great. I think that keep that in the back of your mind. We'll see.
I'm already stressing over what headline I'm going to write.
So like one of the other things that we talk about a lot, or that, when people will ask me what's behind this like massive surge in travel and talk, I usually say the same thing. I believe it to be true. The pandemic really changed kind of the fiber of all of our, of how we feel about things and how we prioritize our money and time. And travel just happened to be one of those things where people said, you know what, like I am not going to skimp on this. I am going to go and do this. I'm going to go see my friends and family and my loved ones. I remember being locked up for 2 years, and it's not going to happen again. Do you think we're done with that? Like, do you think that might be, that's all she wrote for that this like weird period in history, and now that's part of what this, as you said, normalization looks like?
I'll take a stab at answering that, and I want to hear what Lex thinks too. I think the word I would use is plateau.
I have an answer too. Okay. So
right.
At the end, we'll do a round robin.
I love that. All right, I'll be quick. I think partially what we'll see is a plateauing, right? Yeah. I think that, I think in many ways travel is a passion for a lot of people, and people are pursuing their passions. And they want to continue to do so, assuming that they have the money and the time to do so. That's key. So I don't think that like people are necessarily getting more passionate, but I think that, this is to an extent, a structural thing. Like the pandemic was a big deal, and if you were coming of age during that, I think that it had an influence. I have another thought that's like kind of interesting, but I also think it drove some early retirements potentially from some older boomers, and they like to travel a lot. So I don't see how we grow from here, but I don't necessarily think that we mean revert either. That's my take.
Yeah, Lex? I'm with you. I really do think it's here to stay. Just anecdotally and in the numbers, people are obsessed with, it's all anyone talks about is travel. And Seth hit the key point, is like, do they have the money? And so like I think the desire stays, it's getting easier to travel, barriers have come down. So the last barrier to really focus on is jobs. Do people have a job? Can they afford it? Or if you don't have a job, I also talk a lot about just the wealth effect. And there's a lot of like the wealthy retirees and wealthy early retirees who have money. That's a big part of their budgets. And if you talk to them, all they talk about is they early retired so they could travel. That's what it's about.
Yeah. Yeah. And I'm right there with you. I don't think I think what may happen is, we've been talking a lot about how some of the vacationers or the leisure travelers have been kind of invading business class. That maybe that type of stuff kind of, if you want to save money or you're worried, you like take a step back. But I think people are still going. That I think is not changing.
I think that's a great point, though, is that just because people continue to travel doesn't mean that they do so in the same way. So millennials are hitting real adulthood. They're having kids, they're having families, they're settling down. Someone with a family, they will definitely continue to travel. But I don't need to tell you this, Sarah, family travel is expensive. You have to make different choices. Maybe that the extra money you spent on that premium economy seat, you now spend on 2 child seats, right? Like in economy, I don't know. So I think that's a key point, is that it's not necessarily that people stop it. It's about reprioritizing where they are in life and their budgets, I think is the key part.
Yeah, I have wondered a lot about this, as one of the things that shows up in when you talk to travel executives is this chasing of the premium. Like everyone's like, we're doing premium, we're going for luxury, we're going high end. Makes complete sense. That's where the money is. But at some point, that's got to, how long can you go to that well before, when you've got even like kind of lower end travel companies chasing that high end dollar, at some point, I don't think there's that runs dry, I think.
Yeah, or
but the rich got so rich though in these past couple of years,
But yesterday, so again, not to make, I have no idea if the stock market's going to crash. I don't know. But it's almost certain that it cannot grow 20% a year for the next 10 years. At some point, they start spending it down. We know that a lot of the money from the past few years was the stimulus money post-pandemic. That has been spent down. You're seeing those cracks, rising delinquencies on credit cards, et cetera. So I don't know. It could become a problem at some point.
Well, I don't want to keep harping on this, but I would come back maybe to the supply side, which is to say the rich got so much richer, they remain wealthy, and they're more immune to unemployment. They're less affected by job loss or at less at risk of losing their job. But there's a lot more luxury choices these days. Sarah knows this full well. She's reported on it. So it's like, sure, maybe as a market, in aggregate, luxury spending remains the same, but maybe that dollars gets split across these new luxury cruise lines. And, so all these companies want to go upscale. And all of a sudden, there's a lot more choices. That money gets split more ways. It becomes harder to turn a profit. That's another area where, from a stock market perspective, where building luxury hotels takes a long time, and luxury experiences. But in general, and all of a sudden, it's going to space. That's pretty is it luxurious? I don't know. It's a certain type of luxury, right? Like that someone taking a ride on a spaceship is not. That's a trip that they're not in the Ritz-Carlton, and it's the same target.
Right.
Just the thought.
All right. So we're going to leave it there. We're going to take a little break. We're going to come back and we're going to talk about interest rates.
Love it.
All right. Welcome back to the Skift Travel Podcast. As promised, we are going to talk about interest rates. So that is really on the minds of everybody on the street. What is the Fed going to do? How are they going to react to the movements of this last week? And then I guess how does that impact, the big guys and even the little guys? Like what impact will, I don't know. First, tell me what you think the Fed's going to do, and then give me how it's going to impact the industry.
Why don't you grab it, Lex? I'll jump in.
They're going to cut rates sometime. I hope they don't. do like an emergency thing. Like they've been very deliberate the past year in kind of messaging what they're going to do. The expectation is in September they're going to bring interest rates down by possibly, I think it had been a quarter point, maybe it's a half point. In my life, I've always wondered, does the quarter point, half point really matter when you're talking about these like fine little increments? But the idea is money becomes cheaper. You can borrow money, you can save, you can invest, you could do, and that gets the economy going and heads off a slowdown. The flip side of that, I will say, is a lot of going back to the rich people. They've had a lot of money sitting in their money market accounts and they're earning 5%. And that's been, they're just clipping those payments every month. And that's going to start to come down. And that could be a rude awakening for some people and start to eat at spending the faster it comes down.
Yeah, I mean, I agree with Lex that it seems likely that the Fed will cut rates. Just for, I guess, for context for our viewers who are not as well versed in Fed speak, right? Like the federal funds rate right now is between 5.25% and 5.5%. That's like the general, the risk-free interest rate that all other interest rates are based on. As the Fed cuts, you potentially see all other interest rates across the economy drop. It spurs investment. It makes it easier to borrow money. And to Lex's point, the Fed typically cuts in quarter point increments. So if we're at like around somewhere between 5.25 and 5.5, that's a lot of room to cut. So that's one of the points that I saw discussed, which is that, think back to I guess it's kind of long ago, before the pandemic, when the Fed funds rate was at like really low, like 0, 1, 2%, there's not a lot of room to cut. You can't cut lower. I mean, it's hard, very hard to cut below 0. At 5.25, you've got a lot of room to cut. And so there is some optimism there that, like, in a way, these things are circular references, right? They they feed back into each other. The market does poorly. It tells the Fed it's time to cut. The Fed cuts. Then all of a sudden, the economy picks up. So like that's the optimistic case. Hopefully we see a soft landing and the Fed has plenty of room to stimulate the economy.
There's that other dynamic that's weird though. Is like, so the Fed controls the short rate. You've got the long rate. Mm-hmm. And I hesitate to bring up what is it, Seth, $35 trillion in debt that this country has. The fear is at some point those long interest rates start coming up regardless of what the Fed does. And then yesterday would tell us that that's not happening. The second people were scared, they bought treasuries. So no one cares that the United States is $35 trillion in debt. When they're scared, they buy US treasuries because they know it's a safe asset. But there's always been that fear, as long as I've been in this business, that day will end. And that if the Fed cuts rates, the long rate actually goes up. And I think that will hurt investment as well.
One day, everyone's going to flee to crypto as a safe asset, obviously, right?
I was just about to ask about crypto, but I won't. Yeah. I'm just not going to. Okay. So one of the things that we found when we were looking at this story was that the cruise lines seem to be doing really, really well. And that was from their earnings report. Obviously, that was pre kind of market turmoil of the past week. What's going on with the cruises? Why are they doing so well when the rest of the industry, is seeing some cracks? I mean, they were emphatic in their earnings calls. Like, things are going great over there.
It's a great bargain. I think it's like a cruise is a great way to travel, easy way to travel with your family and with kids. And it's a great vacation option. Yeah. And they're seeing that demand is what I think we're seeing. I mentioned this a little bit earlier, and I got this idea from one of the cruise earnings calls, right? I'll read you a little quote. I think this is Royal Caribbean. But, they talked about baby boomers. They said the number of baby boomers reaching retirement age is expected to grow 30% to 73 million by 2030. That's, I think, the Royal Caribbean earnings call. It's there. So, if people are travel's expensive, inflation is high, you're worried about your job, you want to travel, it's a passion, it's a part of your career. How are you going to do a 5-day trip, all inclusive, get everything done? Go cruising. I think it's almost as simple as that. And or you're retired and you want to see the world, and maybe it's an easy way if you're older to see multiple countries and multiple ports all in once too, if you have mobility issues or something like that.
I don't know it as well. To our earlier discussion about premium versus where does the cruising fit in that?
I think it
depends upon the cruise.
Yeah.
If you want to take a Viking cruise, you're going to pay for that.
I think they're similar. Some of them are similar to all-inclusive resorts in that they are not cheap, but they are still value for money. You can get a lot of food and drink and a lot of people on board and a lot of activities, but it's certainly not a small ticket price either. What do you think, Lex?
I mean, I think it's just that's why I was asking. I think it's the trend that we've been talking about. It's like the people they have money to spend. They're spending it on travel. As you say, this fits into the ease part of it too, right? So I know we like to talk a lot about adventure travel and stuff, but there is something that appeals to a big audience, especially the demo that you were talking about, Seth, that want to take cruises and they have the money to spend. And I was struck by how, we were reporting on the same call you were talking about, Seth, and how emphatic they were. In fact, they were responding to an analyst question about Marriott, which was the first I'd seen to start to take down its numbers. And again, only so modestly, but they were just, and an analyst asked specifically about it because their results were on the same day. And that's where they said, no cracks, no deterioration, the consumer is spending.
Well, it probably tells you that they're very different consumers, right? Like if I'm not mistaken, too, on the Marriott call, they called out some of the international travel. And I think in particular, China. Marriott has traditionally been geared towards more business travel, which is recovering, but is not recovering as fast. And cruises, there's very little business travel, very little business deals getting done on the decks of a Royal Caribbean cruise trip. I think it's a very different, it tells you something about, different market segmentation too, I think.
Yeah, China is a big piece of this that we haven't talked about yet. But it's, if we talk about which travel companies are going to feel this, right? So we talked jobs, we talked wealth gap and sort of the haves and have-nots in the economy. So it's who has exposure to that premium segment. And then the third bucket is who has exposure to China. And that's where you'll start to see cracks.
So let's talk about China. Mm-hmm. A lot of the stuff that we have been talking about today has been very geared towards, the U.S. markets, U.S. focus. Talk a little bit about how China fits into all of this and where that, may creep into a slowdown in the travel space.
I think Seth, you may know this as well. They have a lot of debt. The economy has not recovered in the way they'd hoped. It's a very tough situation to analyze because you can't. The numbers aren't as widely available. You don't know exactly what you're looking at, but there's clear signs of a slowdown, and you saw it in Marriott's earnings. We just recently published a story on IHG earnings, which has a very big presence there. And again, they're able to mitigate the slowdown, but they acknowledge the slowdown. So if you have exposure to that kind of spending, your business, that they're the ones who are noting the slowdown.
Is there anyone like in any big sector, group, geographic that's like that you could see coming to the rescue? Like we talk about India, for example, having just a massive surge of middle-class travelers going out there. Is there kind of like a group or two that you foresee as being, that's going to buoy the industry if maybe the U.S. kind of pulls back a little bit?
I think in some ways the U.S. is that market. If the U.S. I think for real, Americans have been eager to go outbound, have been eager to even travel domestically as well, have buoyed the market a lot. I think you also are right to hit on India. That is still we talk about wealth inequalities in the United States. Wealth inequalities in India is a huge deal too. That is still a very upper crust going outbound from India. I think, it's hard to salvage on a global basis. I think I've seen some signs of a little bit of strength in Latin America too. That they mostly stay within their region. Like it's not like there's going to be a ton of, Mexican tourists going to Beijing or something like that. But I think there are some green shoots in that region as well. But that those travelers tend to stay more within that region.
So I want to get some closing thoughts from you both. I want to get kind of like a wrap up of what you've seen in the past week. Maybe bring out the crystal ball. What do you think is going to happen here in like the immediate short term, and then maybe like going out towards the end of the year? And what do you think the election is going to do to this, if anything? Like, Seth, you go first.
There's a lot to unpick there. I think we are seeing. We saw some relatively weak guides into the coming Q3. There's a very real chance we might see some weakness there. I'm optimistic that Q3 should also be right around the next Fed meeting, and there's a very real possibility, and I don't think I'm like crazy for hoping for it, that we see a bit of a dip and a recovery where you maybe see some weakness into Q3, then the Fed cuts, boost the economy, and hopefully I would like to see some strength into Q4 and ultimately into 2025. That's I don't think that's crazy wishful thinking. In 2025, we'll also know who the new president is, so maybe that's a segue for that. I will say I am somewhat of a believer that, politics aside, in an economy like the United States, which is so diversified and where there's a very large private sector, the president matters. It doesn't matter as much as we would always like to think that they do. The president does very much matter for foreign policy. And so when we think about outbound, inbound, if the Chinese economy is getting better in 2025 and Trump is in office, will the Chinese government want to see as many Chinese tourists come and give their money to American businesses? Probably not. If the world is more unstable, if there are more conflicts and regional conflicts in Eastern Europe, in the Middle East, that will hurt tourism. But I think as far as the actual kind of domestic outlook, hopefully we should be relatively well. And one of the things, again, like we've been saying in Skift research, is normalization. We are slowing down, and in some cases we are slowing down faster than investors expected, and that freaks investors out. But fundamentally, it's not like we're in contractionary territory just yet. Caveats apply, but it seems highly unlikely that we'll end 2024 with negative growth this year for the travel industry. And so we're still expanding. It's a matter of expectations versus what is actually delivered on the ground.
Yeah. Lex?
So the way I've been hearing it, I read a column the other day from Paul Krugman, the economist. He writes for the New York Times, and he referred to it as pre-recession. And that's it, which I liked that phrase, meaning, so we're not there yet. There are clear signs of a slowdown. We're in pre-recession. The thing I kind of go to, though, I'm a worrier by nature, so I always expect like, oh my God. But then I've been watching a lot of interviews with Steve Eisman, I believe that's his name, excuse me if I got it wrong, who's from The Big Short. And he's like, so he was like the ultimate. He capitalized on this big collapse, and everyone's always asking him, are we due for a collapse? And he's always just like, what's the problem? We got 4% unemployment. The banks all have money. They're all well capitalized. And they go, what about the debt? He's like, oh, the debt, what? And so he's just like, what's the problem? One day I'll come in here. There won't be a treasury auction that gets bought, and we'll worry. Until then, I'm not that worried. And so I don't know. It's a good perspective to say, yes, even if there is a recession, because we're pre-recession, that doesn't necessarily, every recession doesn't need to be 2008, right? It doesn't have to be Lehman Brothers going bankrupt. Sometimes you just have a recession and businesses adapt and they can get through it. So I don't know. Can I
jump in and add something there? Because I think it's a great point.
Yeah.
I used to work with an economist on Wall Street, and he said this thing I really stuck with me. He says, when you're trying to call for a recession, you really need to ask yourself, what makes it systemic? Like, what's the risk? Like if Southwest Airlines goes out of business tomorrow, that's bad for the airline business. It doesn't impact the energy sector or the healthcare sector. A recession is when everything goes down at once. And so what is systemic? And like you exactly right. Like 2000 houses, banks, there's really maybe energy to an extent. There's only a handful of things that are truly systemic, and especially again, this is U.S. centric. If you're in Iceland and your entire economy is fishing and the fish stop biting, that's a problem. But in the United States, there's very few sectors that are systemic and big enough to put you into recession. So where's the risk? I really like that framing, and it jives with how I think about the world. And hopefully, I don't know, hopefully we're right. I don't want to see a recession. You never know.
Well, I think that is a perfect place to end it today. We do have one question though. So I'm going to pull it out here. Thank you for sending them in. Here it is. Is this dip in the economy a, quote, self-fulfilling prophecy in some sense? It seems like the pundits have been predicting a recession since the pandemic. Is it possible that we have talked ourselves into an economic dip? Are the big players that you know of who stand to benefit, are there big players who you know of who stand to benefit from the recession, like short sellers, etc.? Thoughts?
I think not. I mean, I totally get the question, and I've heard, and it's a legitimate theory. My thought is people's tendency, even if they're negative, and in polling you'll see them being negative about the economy and negative about the outlook, their natural tendency is to spend. The natural tendency is to invest. And so regardless of what is said, the trend is toward growth. And so I don't think you actually, or at least in this case, are not talking yourself into a recession. If we were, we'd already be there because there was so much talk about a recession a year and a half ago. So my answer would be no on that, and that you'll see. That doesn't mean there won't be a recession, but it won't be because of that. It'll be because of, at some point, you've just, as Seth said, invested too much, built too much, et cetera, and then you need to get things back into balance.
Yeah, I agree. I'm happy to give you the last word on that one, Lex. That was a good answer to the question. By the way, we love answering audience questions. So thank you for sending that one in. As Sarah said at the top, podcast@skift.com. Ask us your question and we'll get Lex or someone else to answer the question on the next one.
All right. Thanks, everybody. That's it for today. Thanks for tuning in and listening, and we'll see you next week. Thanks.
Bye, everyone.
Thank you.
Thank you for listening to the Skift Travel Podcast. Wherever you're listening, please make sure to subscribe. If you like what you're hearing, rate us 5 stars or leave us a positive review. It really helps get the word out about us, our podcast, and make sure that we can still continue to bring it to you free of charge every week.
If you're watching on YouTube, be sure to like and subscribe. And don't forget to hit that notification bell as well. That way you'll know every time we have a new episode.